a lot of questions on Twitter when we were talking about the show about the yield curve and the inversion. And I think it'd be great just to hear a quick definition of what the yield curve is exactly. And this inversion, Andy already mentioned it briefly earlier in the show, that it has signaled, I think, the past 8 recessions when this curve inverts. So, Andy, I'll toss this one over to you, this grenade, and let you handle it.
Sure. So the U.S. government borrows money, and it issues bonds to borrow money, or treasury securities, and it issues them with different maturities. So you can lend the U.S. government money that gets paid back 3 months from now, 6 months from now, a year from now, 2 years, 5 years, 10 years, 30 years. Okay. And each of those securities trades in the market, and it has a yield. And normally, the longer maturities carry higher yields for several reasons. The most obvious being that lending someone or something money for 30 years is riskier than lending them money for 3 months, right? You're more certain that you're going to get paid back. What does the US look like 30 years from now? So that's how it's supposed to go. But an inversion is when the shorter term pieces of debt have higher yields than the longer term. And people look at different comparisons. I would say the most common is the 2-year versus the 10-year. So when the 2-year is yielding a higher level than the 10-year, let's say the 2 years yielding, 2.6%, and the 10 years yielding 2.55%, that's an inversion. And generally speaking, it makes us nervous as investors. So that's the short story, but I could go deeper. I'll leave it there.
Press, any color, Dad?
No, the thing that's difficult for a yield curve is particularly in finance, and I'm sure Andy can confirm, for a bank when they're managing their balance sheet and how they go about doing just their business activities as far as lending out currency. If the short end of the yield curve, the 3-month money or the 1-year money, has a higher yield than the long duration issuance, that causes major issues for their balance sheet. Without getting into like anything more specific than that, people just have to understand that it makes banks extremely uncomfortable. For people that hear a lot of this talk and it just seems like a bunch of noise, or just like there's tons of people making posts on Twitter, right? For the person who's not dialed into this, just intuitively, if I was going to lend you money and I was going to lend you money for 3 months versus 30 years, it doesn't take a rocket scientist or somebody really to get into too much. If you're lending your money out for 30 years, you want more interest for the risk that's associated with lending it out for 30 years. It's just that simple. So if today, when we look at the bond yield in this yield curve, what we're talking about is we're looking at overnight money clear out the 30-year money on that curve. And so today, when you're looking at that, the 30-year is at 2.47 and the 3-year is at 2.46. So why in the world would those be at parity when there's 27 years difference in risk that's associated with that? It's broke, right? That is broke. And what I would argue, so the person hearing that is like, well, it doesn't make any sense, but why? Why is the market doing this? And what I would tell you is people that are in the market that are trading billion-dollar bond tranches are looking at this and saying, the central banks are going to have to come to the rescue. And therefore, why would I sell off my 30-year beyond kind of where it's at and maybe a little bit higher? Because they're going to come to the rescue and they're going to stop the sell-off, or they're going to actually step in and manipulate they're going to buy so much that they're going to push the yield even lower, right? And then the person who's trading the desk that has the 3-year is saying, all right, well, maybe they might let this run a little hot, and they'll actually let the free and open market exist and let it sell off. So maybe there's more risk and maybe I need to get rid of it, because they might not do that for another year or another 2 years before they start aggressively doing it. So I think that's why you're seeing that in the market. I'm kind of curious if Andy would agree with that assessment of why you're seeing I mean, because it makes absolutely no sense with 8% inflation prints for the 30-year Treasury to be at 2.47%. I mean, you're just guaranteeing, a 500 basis point, whatever the math would come out to, spread, that you're just losing that no matter what for 30 years. The market is pricing in further manipulation by central banks to hold that down.
Yeah, I agree with you, Preston. I mean, it's telling you that somebody's got to buy on a relative basis. Somebody's buying those longer bonds. I mean, granted, the whole curve basically has been moving upward, quote unquote upward, right? Which is to say, yields in general have been rising this quarter by a lot. Hence, I can't remember Preston or Brady's comment about how the bond market's basically getting murdered this quarter, right? But you do see that flattening, and I agree. It indicates stress. Another way or another factor that could be at play here is the Fed has said, yeah, we're going to raise rates a bunch, and so shorter dated bonds are reflecting that. So if you're going to lend money to the U.S. government for 2 years, or a series of of shorter dated tranches, buying a 2-year bond is in some respects lending for 6 months and then re-upping at the 6 months rate 6 months from now, and then again and again. And the idea is, oh well, if the Fed actually does raise rates, then each of those rates that I'm getting on my bond is going to be higher, or I should say on my bill is going to be higher and higher in series, and it's going to blend to a higher rate. But yeah, the longer dated bond is implying that, well, eventually the Fed's going to have to reverse. They're going to have to lower rates. And so the average blended rate earned by a lender over a several year period is going to be reduced. So like the longer end of the longer chunk of time, let's say 5 to 10 years out, that 5-year period is likely to have a period in which the Fed is once again lowering rates. And so you get this average blended rate through the duration that is skewed by an expectation that the Fed is going to have to do exactly what you said, Preston, which is stimulate, buy bonds, reduce rates, et cetera, et cetera.
This is the real big point with all of this. Can you imagine where our real estate market's going to be in another 2 quarters from now with this?
Tough, right?
I have a lot of concerns about that one.
Yeah, with mortgage rates, when mortgage rates are blowing out from whatever 2.5% to over 4%, yeah, you can buy a lot less house at 4,
a whole
4+%.
lot less house. And so, so this is how this is going to get really unique. So most people in the last year here in the States have seen their house go up tremendously. Canada, I think they're like 100% in some areas in the past year. So let's say you were primarily like completely levered in your house, 90%, 80% levered in your house, and it goes up 100%. Well, if you sell your house, that's just like your loan's paid off, right? You completely captured the same amount that you were in debt just the year before. And so now you can take that down payment, but as you go out into the market to buy a new house, you have to pay for that new house that's double. If you want to sustain your cost, where you sit in the spectrum in society, right? You now have to buy a house that was twice the cost of the one that you previously purchased, or at least the amount of the original bill of sale for the previous house. It's twice as much. Right. And your down payment is kind of similar, but those house payments are going up tremendously relative to, and I'm making an assumption here that your wage really hasn't increased a lot. And for some people, maybe it has gone up. But I think for most people, it probably has not kept pace with 100% appreciation in the house. And I'm obviously using numbers that might not be representative of each person's, location where they're at. But the point is the mathematics on this for anybody who wants to move is it's kind of fallen apart because of those house payments and what it is you're making not keeping pace with that new cost of living that you're trying to sustain. And so I think the fact that you're not seeing a lot of houses on the market, and I don't know if that's true for all locations, but I know where I'm at, you're not seeing a lot of houses for sale like you normally did before any of these market dynamics started coming into play. And I think that what's happening there is a lot of people are seeing, just intuitively understanding that, and they're a little scared to go through that frictional burden of changing to a new house and then looking at like, oh, what's that cost? I think I'm starting to get outside of my cost of living, and I'm having a decrement in my cost of living by moving. And therefore I'm going to hunker down in what I've got and just enjoy my equity in the house going to 50% opposed to 80% ownership based on the value that I could sell it for.
Yeah, that's a big factor. And when you extrapolate to, what does that mean for the economy overall? It means a couple things. First of all, housing is by far the largest asset class, period, right? It is where more capital is stored by a long shot than any other major asset class. Okay, so what happens when you can't pull money out of it? You can't use your house as an ATM, right, as easily because the interest rate is higher. Used to be you could go get a home equity line, or you could just refinance your mortgage at a lower rate. Now you can't do that anymore. So that's missing spending power at the household level, a lot of it. And then, with respect to moving, it's a really good point that you make, Preston, which is the economy does depend to some degree on the dynamism of people being willing to go to where the jobs are. Now, it's true, many people work on Zoom, or at least a lot more now than used to. So it's easier to have remote-only companies or partly remote companies. Nevertheless, there are some parts of the economy where you got to show up physically. And so if you're hoping to keep unemployment low and you're hoping to keep the economy dynamic, but you got all these people who are stuck in their houses because they can't sell and then go buy in a new market where the job is, because now they got to pay a higher interest rate on their mortgage, a higher payment on their mortgage. That's just a negative overall for for the labor market, and it's just a negative economically. So it's often said that as goes the housing market, so goes the economy. And yeah, also, by the way, the housing market is by far the most levered asset class, even more levered on average than Bitcoin, believe it or not, you degen traders out there. And so, yeah, these things matter. When interest rates go up, it's likely to have a sizable effect on housing and by extension, the economy overall.
You know, one of the beautiful things about being a Bitcoiner, which everybody listening to this is probably a hardcore Bitcoiner. 5 years ago, if you bought a $400,000 house, that was 458 Bitcoin to buy that house 5 years ago. Today, that house is only 8.4 Bitcoin. Mm-hmm. So for Bitcoiners, the deflation is real. It's very real. It's dramatic. And I'm here for it.
Hell yeah.
Amen. 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 It's good to live in an inflationary world where if your standard is Bitcoin, then it's actually a deflationary world.
Yeah, dramatically deflationary. And a Bitcoin standard world will still have some deflation, I think, but it'll never be at this rate that it is now as we're exchanging the bad money for the good.